All right, guys. I welcome to this next chapter. We have seen the previous weeks even though have not been trading. Okay, that's why we didn't receive other lessons. But we looked at how to use demand as a strategy. So how to use supply as a strategy. We looked at inducements. We looked at some of liquidity. We took a look at. I remember we also looked at order blocks. How to use order blocks effectively. So in today's lesson, that the one thing I'm going to explain to you guys and understand area value gaps, how to use them, how to make good use, like it becomes a strategy also. A lot of traders use fair value gaps, but they don't know which fair value gap to buy at and which fair value gap to sell at, and that's where I do come in. All right, so in front of you, if I'm not mistaken, the picture all of you guys can see, we see three diagrams. But before I take you to the three diagrams, let's first take a look at what's a fair value gap. How does it work? Why is it there? Because guys, you need to understand how a fair value gap works, what makes it be there, and why is it effective to traders. Yeah. So let me draw the fair value gap that we have, how it looks like, what it is, and how it is formed. Okay, the fair value gap is always formed within the three consecutive candles. Three consecutive candles. That middle part is also known as imbalance. Yeah, a lot of traders have different names for the fair value gap. Some call it imbalance, others call it inefficiency, but everything is the same. So all of you are correct. Now, guys, this is how a fair value gap occurs, and I'm going to give you the logic behind the fair value gap. Guys, if you have ever been at a football match, those of you who play football, those of you who don't play football, I think you have a sport to play in. But I think most of you guys who are playing are boys. When you play football, there is a term we usually use like to balance if they are not balanced. In most cases, we say such words when the other team has maybe good players, some people strong players, I say strong players. In most cases, it happens when a team that does not balance, we always know who will win. So it does not take you time to know that the Ghana Cranes can't win Manchester City. So you will know it that it's not a balanced team. That's why other people will be like the fight was not fair. It was not balanced. So when it comes to markets, most cases when a certain move occurs without presence of sellers carrying in it, it leads to an imbalanced structure. So like I was explaining, guys, when imbalances occur, that means that there is a party that has not been contented. Like I've given you guys an example. If we have a team and this team is strong, like it or not, they are going to win. Yes, most cases, okay, some of us used to win by luck, but we always know that this team will win depending on different factors. So the same thing will be applied and in markets. When market leads to a certain sector, like for example, guys, when do they say we take the middle candle? Let me tell you, why can this be the fair value? That question I received it several times. Most cases, these candles have what we call wicks, not so. So they have wicks. I'm going to tell you what the wicks mean and what happens in market when the wicks are there. So most cases, a lot of you traders, you mark this price level as the fair value gap. Yes, most of you mark it as the fair value gap. So the reason why we consider this sector, this one here, not to have balance with sellers is simply because let's take a look at the dynamics behind the fair value gap. We see a week, which is this first week in the first candle going up. What does it indicate? It indicates buy at that price, seller brought them back. But if you take a great look here, this market takes a bit of this candle. You understand? So at this price, I'm showing what happens. At this price, we see sellers were present here. So it's around this price where they're present. As drawn here. Because here we see sellers, they came in at this price around here and dominated market. Dominating means that they rejected and started pushing market to their direction and dominating it. So we see here sellers came in. Then, of course, buying pressure came in. But all of us have seen it that a bit of this candle has been eaten by sellers previously, so it's balanced. Then we see the upside part. What we see here, we see sellers coming in again to dominate the downside, even though buyers will push them up. So we see another picture whereby sellers are able to dominate up to a certain level. Here where the week ends. So I'm doing where the week ends. So we have something like this. We have something like this around here. So this indicates that in the middle here, we didn't see the presence of sellers. And guys, of course, like I usually say that the reverse is true. What happens in the selling scenario can happen in the buying scenario. So I'm just explaining a bit of how the fair value gap is formed and what happens and why it has to be filled out. So, like I was explaining, guys, when you see the middle here, like because I've used symbology, we come to notice that here we don't have any sellers at all. They're not there because we saw market dominating with a candle here. We saw buying candle dominating market around this price. It dominated here up to the upside, but in this middle part, players they were unable to show the presence of sellers. So this is called the reasoning of the fair value gap and how it's formed. In most cases, the reason why market comes back is to fill out this warning part which didn't bring a balance. So that's why when you guys are playing, we always say that let these people at this time this side give you this side, give exchanges. So what happens is that in a fair value gap, market comes in and fills out the warning parts of market. So that's about how the fair value gap is formed and how to draw it. Most cases, guys, a fair value does not have a specific logic to drawing it. I say it right away without hiding. Mosmania ICT draws, no, we all draw it the same part. As long as you have that point where sellers will unable to to do what? To be present in market. You own a fair value. So okay, in most cases, these two things you see here, these are just shadows of market. These are shadows. These are shadows where market moves in. The reason why I call them shadows, if most of you have took time, I'll show it later on. When you put into a line chart a wick that is not represented, why it's a shadow that shows where sellers buy as well. So that's why the candlestick was evolved and it has a lot of logic behind it. It explains to us what happened even when market has already moved. But the line chart is not, even the line chart is more clear somehow because these candles can confuse. I saw someone wanted to talk, but yeah, it's gone off. So like I explained, we haven't seen the three types of fair value gaps. Which is the most effective one? Which of them should we use and why we should use it? Yes. Now, so hope we have understood what fair value gaps are, how they are applied, and how effective, how they are formed. Because the most important key fact in a fair value gap, guys, is understanding how it is formed, why it is formed, and why market comes back for it. That's why when I began by explaining how it's formed. So, of course, I've used Telegram because most of you voted Telegram because I'm seeing someone is saying he prefers Zoom, but I've used the majority vote. Of course, it's democracy. Now, guys, let's dive into the three types of fair value gaps. We have the first fair value gaps. Okay, the most important thing you should always take time to look at is the seller's rejection. As long as you know the rejection in sellers, you are good to go in what we call understanding fair value gaps and other concepts. If you can't know which part is rejecting, you can't trade because even the demand zones, rejectional levels, everything is almost a rejection. Market rejects at certain levels. The two things I want you guys to concentrate on when we are talking about fair value gaps are the weeks of the body. Because we even say that this body is where it belongs, where the fair value gap belongs, but the week tells us the story of how it's formed. So it means that if I have the story of how something is formed, I know how to use it. Yes. So here we will take a look at, let's take a look at this first value gap. What does it tell us and how to use it effectively? So this first value gap, we see market forming, of course it formed a nice value gap inside. But let's take a look at what happened. We see seller buyers trying to move to the upside this week around this high, but of a sudden the next candle, which is completing our fair value gap, guys, breaks the high. So this high you are seeing here is always a seller's rejection point. Like it's that point where buyers were trying to breach to the upside, but they were unable. Then we see the next candle that market broke that price. It broke that part to the upside. Most cases, if you ever take time to search things, if this happens in 4 hours, you come to see in 15 minutes, other lower time frame. This is a full break of structure somehow. It's a full break of structure, as you can see here. Most cases, you find it out and look at it. So we see buyers dominating. Nowadays, this is where the sad news comes in. A lot of traders see such fair value gaps and they rush. I'll take my 50% retracement zone around this price, and market I could maybe stop losses around there and aim a certain peak. Then of a sudden, market just bypasses your stop loss. Okay, this fair value gap tells a different story from the one we know. Why? Because we see market, if buyers led an imbalance but dominated with momentum to the upside, it indicates that they were they made the imbalance true, it's there, but the buyers are so strong that they are just dominating market to the upside. Now, in most cases, this first type of fair value gap is just known as a fill-up fair value gap. For us to use it as a fill-up, market just comes in, it fills up fair value gap, moves to the other direction. So that happens in most cases, the first fair value gap. We have seen the first story tells us that buyers are not balanced with sellers, but the momentum is quite strong. Now we take a look at second fair value gap here. So this other candle I can also put a week so that around this price, let me just put a week here. Okay, around here. So now we see this second fair value gap. We see the story tells us. It tells us, yes, true, the imbalance structure was formed, quite true, but we see the rejection of price by sellers. Market was unable to close above it. It means that sellers are still strong at the moment. It means that sellers have not accepted the markets. The second level gap is like, for example, you guys are there, you're playing football, and you're like, we won't play because the team is not balanced. So it means that if you guys fail to play, you have formed the second fair value gap. That's the second fair value gap that's formed in market. Yes, sellers have rejected. They're like, we need a balance, but as long as the balance structure has not formed, we won't trade. So that's upon trade sellers. But most cases, guys, the first fair value gap, if most of you have ever took time in the first fair value gap, market just continues. In most cases, that it doesn't even come to fill it up. It just continues to reject it and continues upside. When it comes back, it just comes back to fill out on impacts and continues to the downside. Now, when it comes to the second fair value gap, it is the most effective one and recommended fair value gap checking. Why? After the fill up, buyers will still dominate market because it's theirs. So we see market most cases coming retraced in 50% and bouncing off, as you shall see in the live example. So that's the second fair value gap. And each fair value gap, by the way, has a purpose and a reason of its being there. So if we take a look at the last fair value gap that is always in the market. Guys, like it or not, those are the three fair value gaps that before. All the formulas, they won't come out because it will either form the first fair value gap, second one, or the third one. So the third fair value gap is also common. It occurs, yes, it's a fair value gap has occurred here, but most cases we see a red candle, which is the seller's domination coming in. So most cases sellers coming into markets to show us their presence. They show their presence in market around here. So what you need to understand when it comes to the third fair value gap is most cases such fair value gaps, they just indicate trend continuations to the downside. Most cases you can see it occurring and market moves down, or if it goes up, it will come back and just ignore it. So this is not an effective fair value gap. So if I'm to draw maybe what we call the bars to which each fair value gap is so strong, if I'm to give bars of each fair value gap, I'll highly do like this. So this is a very strong fair value gap. This first one, it is strong. Then when we come to the second one, okay, this is strong. This is a strong fair value gap, guys. Then when we come to the second one, This one, this is a very, very strong fair value gap, and you should always pay attention when it occurs in market. Then the third one is also a strong fair value gap, but that's how the level of power is. So they are all there, they all occur, but the middle one is always the strongest, as we have seen in all examples. The fundamental gap itself guys can be a strategy and can be used multiple ways. I'll show you my first strategy I used to use about fundamental gaps. I practiced it for a long time and it was effective, but somehow I used to use it as a strategy and I sometimes use it because I get opportunities towards market. Now guys, let's take a look at these fundamental gaps that occur here. This is what I was trying to tell you guys that people think that every fair gap is effective. We see all these fair gaps are teaching about. Let's see this first fair gap around this price. This is the second fair gap. Then we see the third one around these prices. And guys notice that there is no strategy in market that is so perfect. It's not there. Every strategy is sometimes violated, sometimes not violated. It's always not a win-win. So we see here the second failure the first failure gap, and thirdly the first one which occurred here from this price. We see a buying candle and later on. Let's take a look at the second failure gap, which is the most effective one. We see market dominating within its zone. Around these prices, if we break down to structures, you will see that we had maybe some small liquidation. Market had to sweep out some liquidity within the fair value gap. So I myself one day make a lesson about fair value gap, about liquidity, and we look at them. So here we see market had made liquidity, so it was looking for certain prices around here. But my concept still lies in and is effective. So we see the first fair value gap being used and effective. Market tapped and no plans. The second one was ignored. But we see after some time, like I said, these are just indicate warning of market and it will just continue to the upside. We see market, it respected the first one and second one, it did. And this one was just a rejection of price and shouldn't get confused. As long as you receive such big wins like this, that's not a inspection towards the fair value gap. Let's take a look again at my other fair value gap that I'm noticing around this price. We see market here forming the middle fair value gap that I was talking about. When you take a look at and you take your long positions around this price and maybe aim just up to some small couple pips down and we aim a little bit higher. Yeah. So this is our fair value gap that was in the middle around this price. So you see the second fair value gap guys is the most effective one. So I'll tell you guys how the first one I used to use it and how effective it was and its win rate. So we see the second fair value gap being effective. Then here we see multiple fair value gaps for me. Like I said, the first fair value gap is just a market continuation fair value gap. But you see here, this is the second one, but we received a small rejection and market shifted downside. Maybe due to other factors like coming from a mitigation zones and all that. So what you need to understand about guys fair value gaps in cases. Fair value gaps to me, it's not a matter that we need to use a current fair value gap. No, let me go back to my fair value gap case. I'll show you how effective I use them and how it turned out great for me. So I'll take out my eraser. I first print out these ones to see. We first see how it can be used effectively. Guys, most cases, some fair value gaps occur and market covers them up. Like this. It comes, sorry, that's not the short position. I need to draw another candle. So we might see market occurring and maybe let's say it covers it up like this, then we continue to the downside. This used to be my strategy. Then markets all of a sudden it continues down. We receive another candle down. But this was a fair value gap that occurred there. We receive another candle down as well. So around this price here. So let me get my illustration tool, demonstration. So what happens when a fair value gap is filled? Most cases, these fair value gaps can, sorry, These fair value gaps can be used again remove this NFA can so alright guys, sorry for the network error. I was saying that when a fair value gap is covered up like this, let me say that this fair value gap has been covered and market wants it. I don't know why it keeps doing that, and let me remove it because it shouldn't be doing it. Okay. So once this fair value gap is formed, most cases markets come back. They come back here. They come back to the zone and use it as a selling part. In fair value gap, I'll show you how I used to use it. How effective it was. You can always take entries within the inside fair value gap that was recently formed, and you take short entries there. So what I mean, for example, let me get the live chat. We see how to use it effectively. So here we see our first candlestick formation, our first fair value formation forming around this price here. But we see market it effectively broke it like aggressively. This was an aggressive move to the downside. Market broke the fair value gap. But like I said, the same fair value gap can be used as a short-term position as long as it was not respected. So that's why if you took entries around this price a little bit, you put your stop loss a little bit there and aim a risk reward ratio of 1 to 3 maybe, you can put a little bit there and aim a 1 to 3 around these prices here. So most cases, the fair value gap, once it's not respected, I see a lot of ICT traders using it. A lot of them, by the way, use it, guys. And you can as well use it if you want. Yes, ICT traders, most of their lives based on fair value gaps. Most I didn't say all of them. So most of their lives based on fair value gaps. They like the fair value gap terminology and how it moves towards market. So, like you can see, several times, as long as the fair value gap is formed, market keeps risk. As long as it broke aggressively, mostly the second one, which we looked at this one, when they break it aggressively, this is an aggressive break to the downside. Most cases, markets just come back to retest it. Stop losses you can always put above this high slowly. Then you aim some pips down here. So a couple pips there. You can always aim maybe a risk reward rate of 1 to 3. You can always aim around this price here. So that's about the fair value gap and how, by the way, they are good and effective. Yes, if you know what you're doing, fair value gaps are good at trading at. So most cases, I'm showing how different traders take their fair value gaps. There are traders who take the recently formed fair value gaps. Like for example, he takes his inside trade around this fair value gap here. But like I said, enter other that fair value gap. These other fair value gaps, I'm not quite sure they don't work well. So I trade that some of them take entries here around the fair value gap here. Other traders they can say no, you know what? Maybe market is moving. Then maybe they said it had broke a certain fair value gap within that price range here. They try to take the previous fair gap. Yes, it's all at the same level, but his fair gap is before, like the one we looked at the other time when it had before. So there are different traders who trade it at different levels. But guys, you should note it and understand it that market only and only moves on in two things. It moves because of fair value gaps and liquidity. Those are two things that I know majorly that move market. The rest, it's not quite true, but market moves because of liquidity and that most cases the fair value gaps are the ones that move market and liquidity. In the AMD scenario, that those of you who do trade at AMD, the accumulation, manipulation, and distribution part, this is what happens and why it occurs, how it moves most cases. The AMD, the Asian range, the Asian forms liquidity for London, London to take out the liquidity. So it comes in, makes out some liquidity, and after the liquidity, London comes in to sweep it out. This is how the three moves are made in market and how effective they are. Then when the London is done, it forms imbalances, which after the value gaps. Then New York comes in to fill out. That's called distribution. So most cases, those are three moves that we majorly receive, even though I'll arrange a class for that, about the AMD class, how to use AMD, how it occurs. You will be able to understand such moves. We receive a consolidation, market distributes to take out liquidity. Afterwards, it manipulates, then distributes to fill out imbalances that are in market. So we'll get a class for AMD, but that's how the AMD scenario comes in and what enables market to move. So most cases, guys, the Asian, which is the weakest section for most cases, we call it weakest, the Asian forms the liquidity. That's why most of you back then in your lessons, they like saying that mark the Asian high and low. So you like marking this. I like, I see a lot of, not many notice handles. Most cases, you guys, let's say that, let's say that that is my Asian. Most of you mark the Asian low and Asian high. But of a sudden, some people don't know why they mark them. Guys, we learn because Asian is a liquidity distributor. It distributes liquidity in market. It comes and forms liquidity. Those are the consolidations that occur at night. We always mark Asian highs and lows simply because we want to know where the liquidity of buyers were and liquidity of sellers were, which is known as buy side liquidity and sell side liquidity. That's why traders, when they take all the Asian high, most of them tend to short in the move. They tend to look for shorts in markets and tend to push it to the downside. Look at sweeping Asian low. But guess what? We are trying to catch out that distribution part. So London comes in, takes out the money, which is the liquidity that has been from Asia, through manipulation. New York comes in to fill out the imbalances that occur. So this is the major scenario that occurs in the AMD, even like I said, I'll arrange a class for that. So it comes in, covers the fair value gaps, and most cases takes out the Asian low, and maybe other structure continues, and so on. So these are the major formation structures that we have in markets, but because guys, AMD, the reason why I like it and use it a lot of times simply because AMD tells us and explains it better why market can never move in a straight line. Because I used to wonder back then when I was trading, back then when I was starting to trade, why can market move straight? Yes, why can we receive market? Why can't it just move like this? And I can understand that as long as market moves under the principles of liquidity and fair value gaps, if it moves straight, it violates all the two rules. It does not sweep any liquidity within inside here. It does not cover the fair value gaps. That's why, guys, no matter how the trend is, no matter how the uptrend, how strong it is, we always receive a downtrend. You will see market dominating the upside like this and make equal highs and lows. The reason why it's forming such, those of you who have took time and have understanding, because this is a consolidation. Most cases uptrends form in balances first and balance structures. So these are just consolidations. Market breaks out in consolidation. Guess what? It's breaking out to take out liquidities at these price levels inside here. So market takes out liquidity trends. That's the scenario why markets, after the uptrend, most cases we receive downtrend structures. The downtrends come in to take out liquidity, this liquidity share, this liquidity at this price, then as well as to fill out downtrends. And afterward, we receive maybe consolidations to generate liquidity for market and trends continue so and on. So most cases, guys, market itself can't fight liquidity and imbalances. As long as the imbalances have occurred and are there, as long as these imbalances have occurred and liquidity is there, we attract market towards that level. That's why a lot of traders, for them, they used to say that imbalances, fair value gaps, and just margins of market. Yes, they are margins of market, guys. When a fair value gap occurs, it attracts market towards it. That's why, guys, if you know where the most liquidity is and fair value gaps, you know where the market is headed. Let me give an example around here. So we see here, let me go back a little bit back here. Let me go back here. We see what happens and how the market is attracted towards that zone. So we see here around this price here, around here, we see market had liquidity down. It had liquidity. Multiple fair gaps had formed inside. Then after market just got a supply level to be used as a level of attracting liquidity to the downside. We saw liquidity which was around this price as I was teaching the other time. Other blocks, we saw liquidity was swept. This is what the liquidity sweep. Then when the market stopped here, it reminded itself that I have imbalances here and some liquidity around this price. That's why we had to receive a massive drop to the downside. So most cases never waste your time to take an entry which does not have which deals with liquidity or form failure gaps. Like for example, a guy who took this demand level, yes, he was true, it was right, but what was the reason for the takeout? So most cases, guys, as long as different factors are not forming, it does not give you the right or the confluence to take entry. For example, you can't take a demand around this price where market deals with multiple liquidity. Guess what? Your liquidity, after the liquidity you have, as long as it's a lot that market is taking, it will hit you up. That's why I tell traders take entries where if at least this kind of had grabbed liquidity, it had grabbed this, if it had grabbed this liquidity, it would be a nice sniper entry to the upside. But we see market did, meaning that these are just liquidity zones. But here we see market, this kind of grabbed the liquidity around these prices here. That's why it was effective. But this one was not, regardless of market taking out some small liquidity here. But as long as this other week was not grabbed, guess what? Market had to reverse to the downside. That's why, guys, in most cases when you see such candles, they don't indicate trend change. For example, market was like that. That's the candle, and we have a very long week that occurred down. And most cases traders say that buying pressure is there. We are looking for buys. A candle can occur like this. Very long week, they pull it to the upside. This candle does not indicate a buying pressure. It instead tells us that there's liquidity around these prices. That's why markets they consolidate and take out this low. Let me give an example here. You take a look at this price. All right, so let me use this. Let me use this one here. This week here. Let me use this one here. So let me break out to the 30-minute time frame. We take a look at what happens at that price level and why say that it's just a liquidity zone. So we see a market, it formed a very good week. Let me further break it down, but that was maybe news. That was maybe a news formation. Yeah, most cases some of them are news. But if you break down the same candle in 1 minute time frame, for example, if you break it down, you can see that there are multiple liquidity zones that are forming around here and fair gaps. That's why you see after the week formation, we received market coming back to dominate the upside. And guess what? On the other second week, we see the 15-minute time frame is not the same scenario as this because this is liquidity. Here, market formed imbalance. Like I said, you can always take advantage within the previous formed imbalance that was violated completely. We see an aggressive move, a violation that market after retest, it afterwards gave a little bit of some dips down. Stop loss around maybe the fair gap. Even though the stop losses are always big in fair gap trading, but the risk to reward ratio will always come out. Some traders, some of them can say that I'll take only if it hits the 50% around this price, but you can miss moves because of 50%. That's why I myself what I do. If I don't want to take it at exactly here, I maybe look for moves around this price reaching. For example, let me show you where the entry was and how you could have utilized the money. So there was a previous trader value gap, but the guy with the previous trader value gap had a big stop loss like I've seen. But if you had used that second trader value gap which formed around this price, took entries in the middle part here, and placed the stop loss above the trader value gap here, you could have earned a lot. But if you had used the previous trader value gap, it was not going to work out well for you. So yes, Mitchell, you have a question?
Yeah, I was just asking. You told us, actually, you talked about a demand zone, the other demand zone that was down, whereby price just pierced through and went down. So meaning for us to mark a demand zone, it has to first sweep. At least the wick should be below the candle that's dropping down, as in the sell candle.
Very true. Sorry, Michelle, I was saying that it is very true what you have said. Market should have grabbed the liquidity. So that we accept that if market didn't grab any sort of liquidity, it's a very big sign that we are the liquidity market is coming for. Hope you have tried to pick me up.
Yeah, it's okay. Actually, on that candle, you marked as in the one that tapped into the fair value gap. So if at all I'm to mark it as a supply zone, it should have grabbed liquidity.
It should have grabbed liquidity to be effective. But since it didn't grab liquidity, guess what? Market just grabbed its liquidity. It acted as the liquidity for market. That's why the true entry was at trader value gap. That's why market should grab the liquidity before considering that level to be either a supply or a demand level. An effective one, and also market should have something it should sweep. We should get market sweeping some liquidity as it comes, then market grabbing the liquidity before it reaches. Let me give an example, Marshall, here. We not even that we see here market here forming a demand level around the price. Even though this was news, I can't use this as an example. This was some news formation. Let me get here. It's here. We see this as a bit demand level, but as long as market did grab liquidity here, market came and took out. This is a stop loss hunt. Market stop loss hunted some people, but as long as your liquidity is grabbed, you are the safer side. I like saying safer side because it's true. Let me give an example here. If I want to get areas that didn't have news so that we can use those. Let me go back to 1 hour where I usually mark my demand levels. These other time frames they overlap. Yeah? So you see currently where market is. We see market this week grabbed liquidity. That's why it's currently at demand, and the demand was effective. Why? We see market grabbed liquidity and market tapped into it. As long as the liquidity grab was there, the demand became more valid. But if you take a look at this other demand didn't grab liquidity. That's why it acted as liquidity and market pushed to the upside. One of the things you hear traders saying, it hit like it grabbed my liquidity after hitting me, it went to the direction. You take a look at this beautiful supply that occurred around this price, even though we received a small stop loss hand. That's why when we enter such trades, you always take 50% of the retracement zone around here. So the liquidity, the reason why markets gave out a sweep out, it's because this candle here, which is supposed to be the true supply, it did grab its liquidity here. So market just acts this as a liquidity grab. That's why some traders, when they see such and they don't really want to risk a lot of their money, they'll take after the liquidity sweep up. Let me show you another example. Here we see a fair value gap that grabbed liquidity. Why do I say grab of liquidity? This body does not have a wick. That means that it doesn't have liquidity. So it was a safe zone to take entries. That's why after some time, we see people who took shots and aimed at small pips here after market having a safe zone, they of course made money. Because what was our liquidity sweep? Guess what? This was the liquidity sweep, this one here. This was the liquidity sweep. But like I said, the zone you're taking that didn't grab liquidity, it's a very, very big chance to be that liquidity. Yes, I like saying it because that's what happens in most cases. So that's when it comes to applying liquidity in your strategy, and it is also something. Also, those who do trade, for example, Quantz levels. The Quantz itself, it's always nice to take a Quantz model that previously had. Let me show you here. If it's moved, let me give an example here. If, for example, this was the Quantz theory and market, of course, made a continuation, then around this price and want take entries, market should have come and grabbed certain liquidities here. Like I always teach, this is the most effective liquidity grab for the Quantz model. Also, market, to make it a valid Quantz model, market, this zone should not have liquidity, it should have grabbed liquidity. Because what most markets do, they grab that zone, the Quantz model is still valid, it tends to shift to the downside. This such scenario happens several times that I can't really explain. Let me get an example here. We see if we can identify a Quantz model that was effective, and we use it. I'm looking for a perfect Quantz model that is not at news time. Yes, because most cases the things that violates market is news. So here we see a beautiful Quantz model. Let me delete out everything. Here we see a beautiful Quantz model level. So it's around this price. It's around this price. So like I said, guys, this week, as you can see, the week even within the Quantz model grabbed liquidity inside there. We see this week grabbing liquidity around these prices. Even though it formed a little bit of liquidity, the reason why we had confluence to take towards the Quantz model is simply because market had a lot to eat before it came. So we saw market coming to sweep out the whole of this liquidity. That's why the true entry model, after identifying the Quantz model, was below this body, was below. Maybe even if you don't say below, you could have took at the demand level, which was as the safe zone, which had already grabbed liquidity and was safe to be taken. After liquidity grab, we see a Quantz model here. We see markets forming out break of structure to indicate trend continuations to the upside. After market tapping to the demand, it made a very lovely move to the upside and gave a couple of pips. Now here, guys, the Quantz model was not this. I know a lot of people are saying this was the Quantz model around this price. Guys, the Quantz model, that one of the factors, it should have led to a break of structure and a change of character. So you can't consider this as a break of structure in most cases. No. For us, we don't like week to week. We like the body breaking, not the week. So that means that if market maybe had come out and violated this zone, this area would act as a Quantz model. Yes. So that's what I had for you when it comes to fair value gaps and using some little bit of liquidity to take entries. Yeah. So in case I have a bit of questions, you guys can ask